You decide to start investing just $1,000 a month in your 20s. Fast forward 30 to 40 years, and that one habit could realistically turn into $1 million or way more. Most people think you need a huge salary, a fancy degree, or a lot of risky bets to become a millionaire. But here's the truth: consistent small habits, time, and something called compound interest can get you there. In this video, I'm going to break down the math, the timeline, the mistakes to avoid, and the mindset you need to make investing $1,000 a month, a total game changer for your financial future. Why $1,000 a month is a great target. So why $1,000 a month? Well, let's break it down. $1,000 a month is $250 a week. And when you look at a whole year, that's $12,000. Now, if you're earning $60,000 to $70,000 a year, and you're keeping your spending under control, investing $12,000 a year is absolutely doable. It's not easy, but it's realistic. But here's the thing, it's not really about the $1,000. What actually matters is that you invest consistently over a long period of time. Maybe you can't start with $1,000 a month right away. That's totally fine. Maybe you start with $200 or $300 a month and then slowly work your way up. You can do that by cutting unnecessary expenses, getting a raise at work, or picking up a side hustle that brings in an extra $100 or $200 a month. Any step you take to increase your investing amount will pay off big time down the road, especially if you start young. And speaking of starting young, if you begin investing at 18, 19, or 20 years old, you will be so far ahead of everyone else. We're going to talk about the math here in just a second, and it's going to blow your mind. What is compound interest? First, let's define compound interest because this is the engine behind everything. Albert Einstein supposedly called it the eighth wonder of the world. And honestly, it deserves that title. In simple terms, when you invest money, it earns a return. Then that return earns its own return. And then that earns a return. Over and over again. It's like a snowball rolling down a hill. The longer it rolls, the bigger it gets, and the faster it grows. Let's walk through the numbers using $1,000 a month and an 8% annual return. Why 8%? Because the stock market, specifically the S&P 500, has historically returned about 10% per year. Once we subtract around 2% for inflation, we get a real return of about 8%. In year one, you've put in $12,000. Let's say no growth yet. You're just building the habit. By year two, you've contributed $24,000, but now your first $12,000 is growing at 8%. Your portfolio is already above $25,000. By year five, you've put in $60,000, but your portfolio is worth around $70,000. The gap is already starting. Now, let's jump to year 30. You've contributed $360,000 of your own money, but your portfolio is now worth over $1.3 million. That's nearly $1 million more than you put in. Not from luck, not from gambling, just from time and consistency. And if you go all the way to year 40, you've contributed $480,000. But your portfolio has grown to over $3 million. $3 million from $1,000 a month. Why starting early is everything. Let's say you start investing at age 25 and you go until age 65. That's 40 years. At $1,000 a month with 8% returns, you end up with around $3 million. Now let's say you wait 10 years and start at 35 instead. You still invest $1,000 a month, but now you only have 30 years. Your final number? Around $1.3 million. That's almost $1.7 million less, just because you waited 10 years. And if you start even earlier, say age 20, and you invest for 45 years, you're looking at somewhere around $4.5 million. Starting just 5 years earlier than age 25 gives you over $1 million more. That is the power of time. Time is the most valuable thing you have when it comes to investing. Don't waste it. How to actually get started. All right, so now you know the why. Let's talk about the how. Step 1. If your job offers a 401k match, use it. This is literally free money. Let's say you make $50,000 a year and your company matches up to 6% of your salary. That means you put in $3,000 and your company adds $1,500 on top of that. Never leave that match on the table. It's one of the best financial moves you can make. Step 2. Open a Roth IRA. A Roth IRA is a special retirement account where your money grows tax-free. As of right now, you can put in up to $7,000 a year. The best part, when you retire and withdraw the money, you don't pay any taxes on it. That's huge. Step 3. Make sure you can buy fractional shares. Some investing apps let you buy a small piece of a stock instead of having to buy a full share. For example, if one share of an index fund costs $600, you don't need $600 to start. You can invest $25 or $50 at a time and slowly build up your position. This makes it way easier to start with whatever money you have. Apps like M1 Finance and Robinhood both allow this. Step 4. Just start with what you can afford. If $1,000 a month feels way too high right now, that's okay. Start with $100 or $200 and build from there. The most important thing isn't the amount. It's the habit. Once you make investing a regular habit, increasing the amount over time becomes much easier. Step 5. Avoid lifestyle inflation. This one's tough. When you get a raise or make more money, it's tempting to just spend more. Nicer car, bigger apartment, more eating out. But if you can keep your spending roughly the same, even as your income grows, and invest the difference, that is how real wealth is built. Step 6. And this is the hardest one. Don't touch it, seriously. Leave it alone. When the market drops, and it will drop sometimes, don't panic and sell, just keep investing. This strategy is called dollar cost averaging. You're buying shares whether prices are high or low, which smooths out your overall cost over time. The market has always recovered from every dip in history. The S&P 500 has never had a negative 20-year return, ever. Common challenges and how to beat them. One challenge you might face is feeling like you don't make enough money to invest. The fix? Look at your expenses. What subscriptions can you cancel? What are you spending money on that you don't really need? Even freeing up $50 or $100 a month makes a difference when you're starting out. Another challenge is market volatility. Watching your investments go down can be scary. But remember, dips are normal. They're actually opportunities to buy more at a lower price. If you look at the 2008 financial crisis on a long-term chart, it looks like a tiny bump. Time heals market drops. You might also feel like you're starting too late, but I promise you, it's never too late. Starting at 30 or 35 is still way better than starting at 45 or never. The best time to start was yesterday. The second best time is today. And if you don't know what to invest in, here's my simple answer. Buy an index fund. Something like VTI or VOO. These funds track the S&P 500 or the entire US stock market. When you buy one of these, you're basically buying a tiny piece of the 500 biggest companies in America. You're not betting on one company, you're betting on the entire economy. And historically, that bet has always paid off over the long run. Imagine your future self. Picture yourself in your 50s or 60s. You've been investing $1,000 a month for decades. You've got a massive nest egg. You have options. Early retirement, passive income, maybe starting a business. You're not stressed about money. That freedom is what this is all about. In summary, investing $1,000 a month consistently, especially when you start early, can make you millions. Compound interest works like a snowball. The earlier you start rolling it, the bigger it gets. Use your 401k match. Open a Roth IRA. Buy index funds. Avoid lifestyle inflation. And whatever you do, don't stop investing, even when things get rough. As long as you have a phone, you can download an investing app today and start this week. It might feel boring at first, but boring is what makes millionaires. So how much are you investing every month right now? Drop a comment below. I'd love to hear. If you found this helpful, hit that like button and subscribe. I'll see you in the next one. I'll see